Continuing with our discussion from Chapter 15, we're now going to talk about share appreciation right. A share appreciation right, or SARs, are rights. So these are abilities granted to selected employees. So certain employees get this right that enables them to receive either cash, shares, or a combination of both equal to the excess of the market value over the stated price of the corporation stock on the date of exercise. A company accounts for a SARs plan using what we call the fair value method. For SARs, the fair value can only be determined on the date the rights are actually exercised, so when they purchase the shares. To record the compensation expense, though, the company has to estimate the total compensation costs, and that's made at the end of each year based on the fair value of the share appreciation rights at that time. Adjustments are made after each service period has expired. So here is a timeline of what we're talking about. So these stock appreciation rights are provided on the date of grant. The employees have to work for a certain service period, and then they have the ability to exercise. The compensation expense related to these stock appreciation rights will be recognized over the time period from the date of grant to the actual date of exercise. Now, here's an example. January 1, 2016, when the market price is $60, Wolf Corporation grants share appreciation rights to selected employee Tom Essman. Under this plan, Tom will receive cash for the difference between the quoted market price and $60 for 1,000 shares of Wolf's common stock on the date of exercise. So that's the plan. He'll receive cash for the difference between the market price and $60 on 1,000 shares of common stock on that future date of exercise. Tom has to work at the company for 4 years, and the rights have to be exercised within 10 years of the date of grant. So he has 6 years after the service period. On the grant date, Wolf estimates that the fair value of each stock appreciation right is $17. Wolf makes a memo entry only because there's no employees aren't working. Tom didn't work at all yet to have compensation expense. This is the day, the grant date, January 1, just a memo entry indicating that the estimated fair value of the stock appreciation right is $17,000. $17 times the 1,000 shares. On December 31st, the fair value is $20. So on that date, Tom exercises the rights when the quoted market price of the stock is $94 a share. Tom's compensation is calculated then by taking the $20 fair value of the stock appreciation right times the 1,000 shares. The journal entry to record the compensation earned in the first year of the 4-year period then would be 1/4 of it. Compensation expense is debited. SAR compensation payable is credited. Now, the next year, the estimated total compensation expense will be $30,000 because there's a $30 par value or a market value. By the end of the second year, 50% of the estimated compensation cost should be recognized. or $15,000. You've already recognized $5,000 of it last year, so recognize $10,000 of it now. In the next year, the SARs have gone down in value to $18, so the total compensation is only estimated to be $18,000 overall now. By the end of the third year, you should have recognized 75% of the compensation, or $13,500. You've already recognized $15,000, so really you're going to decrease the compensation expense by $1,500. On 12/31 of 19, the end of the service period, the fair value of the stock appreciation rights, $26 a share, a stock appreciation right, or $26,000. All 100% should be recognized by the end of the service period, so all $26,000. You've only recognized $13,500, so now in the 2019, $12,500 should be recognized. On 12/31 of 2020, the date of exercise, the fair value of the SAR, remember we're recognizing compensation expense until the exercise date, $34,000, 100% should be recognized by the exercise date, or $34,000, you've already recognized 26, so an additional $8,000 should be recognized by the 2020. So there's our journal entries. Debit compensation expense, credit stock appreciation right, compensation payable. Okay, so that's how we handle stock appreciation rights. Now we're going to look at preferred stock, which is different than common stock, and finish off the chapter talking about, preferred stock. There are various preferred stock characteristics, and they may be specified in preferred stock contracts, so right on the stock certificate. They usually get dividends first, and they're usually already a stated dividend amount. They also may accumulate dividends. They're called cumulative dividends. They may participate in excess dividends if there's any option to. They may have the ability to convert their preferred stock to common stock. They may have a special attachment or stock warrant attached to their preferred stock. The corporation may have the ability to call back the preferred stock, just like a bond. There may be a mandatory redemption of preferred stock, kind of like a liability would, at a future maturity date. And there's a preference to assets upon liquidation of the corporation. So they usually get their payment first of any leftover cash before the common stockholders do. So they have different kind of characteristics than the common stockholders. Here's the biggie. They lack a voting right. So although they have a lot of preference with money when it comes to voting, they don't. Common stockholders do. So let's talk about preference to dividends. A corporation must pay any applicable dividends to preferred shareholders before common shareholders. Now, they're not required to declare a dividend each year, but when they do, preferred shareholders get their dividends first. Tusker Corporation has outstanding 5,000 shares, 6%, $100 par preferred stock. Remember, this 6% is a dividend rate. 6% of par is how much money one share of preferred stock will get. So 6% of $100 or or $6. There's 5,000 shares that they're paying this $6 dividend on. So $30,000 is the amount of the preferred dividends. Take a look. So the corporation, if it declares at least $30,000, all $30,000 goes to the preferred shareholders. A preference to dividends does not guarantee that you'll get a dividend each year. So what happens? Since we're usually, as a preferred shareholder, only locked into that amount of money, preferred stock could have this characteristic called cumulative or non-cumulative. Non-cumulative preferred stock, which is rare. It's a stock carrying a provision that the holder will never be paid any dividends from a year that they didn't receive a dividend. So if the corporation didn't declare a dividend this year, preferred shareholders wouldn't have gotten that $30,000. They would lose it. Cumulative preferred stock, though, is different. It keeps track of the preferred dividends that aren't paid to those preferred shareholders because the corporation did not declare a dividend. It is not listed as a liability because the corporation does not create a liability until it actually declares a dividend. But we track that information and call them dividends in arrears. So there it is. If a stock corporation fails to declare a dividend on cumulative preferred stock on the usual dividend date, that amount becomes dividends in arrears. Then when the corporation ultimately declares a dividend, those dividends we've been keeping track of that were never paid to preferred shareholders would be paid first to them. So they accumulate from period to period. We call them dividends in arrears. They are not liabilities. Remember, there are no liabilities recorded with regards to a dividend until the board of directors obligates the corporation to pay cash. A corporation cannot pay common shareholders any dividends until it has paid all the preferred dividends in arrears plus the current year dividend. Take a look. Cali Corporation has outstanding 1,000 shares, 10%, $100 par cumulative preferred stock. So each share of stock is entitled to a $10 annual dividend. If Cali does not pay dividends in 2016 and 2017, the preferred shareholders would have never received those $10,000 in dividends. So somebody would be keeping track on a piece of paper somewhere. Hey, we have dividends in arrears for our preferred shareholders of $10,000 as of the end of 2016 because we never declared a dividend and paid them, and 2017. At the end of 2018, the corporation would have to pay $30,000 to preferred shareholders if they declare a dividend before it could pay any dividends to the common stockholders. Now, sometimes they're a little snafu-y. Participating preferred stock. Some preferred stocks carry a provision that preferred shareholders can actually get more of a dividend after common shareholders get their dividends. It's called participating. It may be either fully or partially participating. If you're fully participating, these shareholders are shareholders who share equally with the common shareholders in any extra dividends after common shareholders are paid. Partially, you would share in extra dividends, but the participation amount is limited to a fixed rate or an amount per share. But the big thing here is that you're not locked into just your dividend rate times the par value. You may get extra. So you want to take a look at that one in your book. I apologize, I don't have my book in front of me. I'm recording this at home and I forgot to bring it home with me. So if you have any questions, post them on the discussion board. Convertible preferred stock. Here's another characteristic preferred stock can have. Sometimes it has a provision on the preferred stock certificate that allows shareholders, at their option, if they want, to convert their shares of preferred stock into another security of the corporation, usually common stock. What's the big deal there? Well, now you have a voting right that you didn't have before. Accounting for the conversion of preferred to common is very straightforward. We use what's called the book value method. You don't have to worry about searching for fair values. Watch. Pender Corporation originally issued 500 shares of $100 par convertible preferred stock at $120 per share. Each share may be converted into 4 shares of $20 par common stock, and all the shares are converted. So what do we mean by this book value method? Well, how much money did we sell those original 500 shares for? 500 times 120. I should do that in my head, but I'll probably give you the wrong answer. $60,000. That's the book value. So the total amount they received for the common stock, or for the preferred stock, is how much we'll take out of the preferred stock accounts and transfer into the common stock accounts when it's converted. Watch. Preferred stock will be debited for its par value, the 500 shares times the $100 par. The additional 10,000 received, because they received a total of 60,000 when they first sold it, will be debited to additional paid-in capital preferred stock. So now we've eliminated the preferred stock because we're converting it into common. So now the question is, where does that 60,000 go to? Well, remember it converts to 4 shares of common. There's 500 preferred, so 4 times 500, 2,000 shares of common stock. The common stock has a $20 par value. So 40,000 of the 60 will be credited to the common stock, and the excess of 20 additional paid-in capital from preferred stock conversion. Okay, so it's whenever you see an additional paid-in capital account, it automatically, that account will appear in the contributed capital section of stockholders' equity on our balance sheet. But we convert it at book value. If the total contributed capital eliminated for the preferred stock is more than the common stock par value, the corporation records the excess as an increase in additional paid-in capital related to the conversion. That's what we just did. The conversion of preferred stock to common changes the components of stockholders' equity, meaning it transfers money from preferred to common, but overall the total amount in stockholders' equity is not changed. You just took it out of one category and put it into another, but it's still within stockholders' equity. All right, the next item. What if we have preferred stock with these stock warrants? We talked about stock warrants. So we may also attach warrants to preferred stock to give someone the right to buy common stock or a security with the warrants. These warrants represent rights that allow the holder to purchase additional shares of common stock at a special price over some future period. Because they are detachable, so they are considered in and of itself an investment, a separate item, separate from the preferred stock. They could be traded on the stock market. So you can buy the right to buy stock at some market price. So at some price. So these are traded and have a market price. The investor in detachable preferred stock has 2 rights. 1, they're the owner, and 2, they have a right to buy stock, common stock. They have a right to dividends that will be paid on the preferred stock, and the right to the market appreciation of the common stock that may be purchased as a result of the warrant. So how do we account for this? Well, let's take a look at an example. Belmont Corporation issues 1,000 shares of $100 par value preferred stock at a price of $120. We've seen this. We would debit, okay, let's keep going. It attaches a warrant to each share of stock that allows the holder to purchase 1 share of $10 par common stock at $40 a share. So now the question is, when they sell this stock, they are selling 2 things, preferred stock and the right to buy common stock, and a detachable warrant, a detachable right. How do we split up that 120 a share? Keep reading. Immediately after the issuance, so after the sale, the preferred stock begins selling X rights without the rights. So just the market value of the preferred stock, no warrant on it, is $119 per share. And the stock warrants have a $6 market value. They're selling at $6 a share. So now let's compute how much of that $120 per share that we originally sold this preferred stock for will be allocated to the preferred stock. How much is allocated to this warrant? Again, we do it just like we do whenever we sell more than one item or purchase more than one item for one price. We allocate it based on the fair market value. So the fair market value of the preferred stock will be $119,000. $119 a share times 1,000 shares. The fair value of the warrants are $6,000. 1,000 warrants times $6 a share. $6 a warrant, I'm sorry, market value. So the total market value, when you add those two together, is $125. $119,000 of that should be allocated to the preferred stock. So 119 over 125, that ratio is how much of the 120,000 is allocated to the preferred stock, or 114,240. We do the same thing with the common stock warrants. The 6,000 market value of the warrants is divided by the 125. That ratio of the 120,000 original amount we sold the preferred and the warrants together at will be allocated to the common stock warrants. So we've allocated all 120,000 between the two. So the journal entry, debit cash, 120,000. That should be 120 times 1,000 shares. Don't let that confuse you. 120 times 1,000 shares. Credit preferred stock for the 1,000 shares times the $100 par value, 100,000. The excess up to, because remember we allocated a total of 114,240 to the preferred stock, so the 14,240 additional paid in capital preferred stock. And then we would credit the common stock warrants account, which is a paid in capital account, 5760. And store them there until they are used. So that's what would happen the day we sell preferred stock with stock warrants attached. What happens when these warrants are actually exercised? So Belmont makes the following journal entry. Remember, they could exchange a warrant for a share of stock at $40 a share. If the market price is much higher, that makes sense for them to do that, the people who own the warrants. So they take the 1,000 warrants times $40. So the company will receive cash of $40,000 from whoever owns the warrants. They will debit also common stock warrants. That total value, the $40,000 and the common stock warrants of $57.60, that's what we're saying there is actually people paid $45,760 in total to purchase this stock. So that's how much we allocate to our common stock account. But only 1,000 shares times the $10 par is credited to the common stock. The excess of $35,760 is allocated to the additional paid in capital common stock. Callable preferred stock. Callable preferred stock is stock that may be retired or recalled, kind of like when a bond was callable. So a corporation may do this. So it's a corporation initiating it. Lee Corporation has outstanding 1,000 shares of $100 par callable preferred stock that it was issued at $110 per share, and they have no dividends in arrears. If they call the stock back at $112 a share, Lee makes the following journal entry to record the call of these shares. First, they'll remove the preferred stock. They're calling it and retiring it, all 100,000 par value. 100 times 1,000 shares. The excess $10 per share that they originally sold it for must be removed from additional paid-in capital, or the 10,000. We'll credit cash for the amount of cash they have to pay to call it back, $112 a share times the 1,000 shares. The difference, or the excess cash they paid, is debited to retained earnings. So we don't debit a loss account, we debit retained earnings. It's kind of like the ultimate garbage can. When there's nowhere else to put it, debit retained earnings or credit retained earnings. So we're not allowed to call this a loss on our income statement. We debit retained earnings directly. Redeemable preferred stock. In contrast to convertible and callable, some preferred stock is redeemable. It's just a different way of looking at it. Redeemable is stock that may either be subject to mandatory redemption at some future date for a specified price or redeemable at the option of the holder. So callable is that, hey, if the corporation wants to call it back, they can. Redeemable is more about it will be called on this date, or the person owning the stock can force the corporation to buy it back from them. So it's just a different way of redeeming or sending the stock back to the corporation. Mandatory redeemable preferred stock is reported as a liability, not equity. Yeah, because if you're saying, or if the corporation is saying, hey, we have to buy this stock back on this date, that's like paying off a liability, like a bond. It's no longer equity. Okay? Preferred stock that is redeemable at the option, though, is not a liability. It is reported in shareholders' equity because it may or may not. Let's take a look at some of those examples in your book. I think this is one of our final areas. Preference in liquidation. If a corporation liquidates, meaning it sells its assets, pays off its liabilities, the preferred stock contract usually allows the preferred shareholders liquidation preferences over common shareholders, meaning they'll get their money first. The preference is typically expressed as a percentage of the par value, so they know how much they'll get in liquidation, and then common will get whatever's left over. It also frequently requires the payment of any dividends in arrears before the liquidation dividends are paid. And a corporation discloses this information either parenthetically, so in parentheses on in the stockholders' equity section, or in notes to its financial statements. Okay, so that is preferred stock and all the different things that can happen with it. Our next area is treasury stock. Treasury stock is not a new kind of stock. It's a label that the corporation puts on its own stock that has already been sold and paid for by the shareholders, and it has been legally issued, reacquired by the corporation, and is being held by the corporation for future issuance. So the corporation has become an owner of itself. So we label those shares of stock treasury stock. So why does a corporation buy its own stock? Well, it may use it for promises it made to employees to give them stock. It may use it as a bonus, and they may not have stock available to give to them. They may buy it to use in conversion of convertible preferred stock or bonds. They may need it to pay those things off. They may have excess cash, and they say, let's go and invest, and let's buy low and sell high, just like any other investor in a corporation stock. They may use it in acquiring other companies. They may use their own stock to acquire other companies. They may signal to the capital market that the company managers believe the shares are underpriced. What does that mean? Well, when we talked about this before. When you have more of something in the market, the price tends to come down. But when you pull stuff out of the market, so if the company buys its own stock, it now has pulled some of the stock out of the market. That will cause the price to go up. So that's what we mean. If the company feels it's underpriced, they'll pull stock out by buying it back, and the price will go back up. So, what is treasury stock and how's it accounted for? Well, it reduces the number of shares held by hostile shareholders and thereby reduces the likelihood of being acquired by another company. There's another reason companies will buy its own stock: to raise the price on the stock to prevent another corporation from buying them. They try to outprice it, raise it so high the other company would not want to buy it. They may use it for the issuance of a stock dividend. What's important to remember is treasury stock is not an asset. So when the company buys its own stock back, it does not debit an asset account. To ensure that treasury stock is handled in the best interest of the shareholders, states have passed laws regulating corporate activities. A corporation must acquire treasury stock for some legitimate corporate purpose, and it does not vote. So a corporation has no voting rights, it has no preemptive right on that stock it owns of itself, and it gets no dividends or liquidation. And treasury stock has no participation in stock splits. Okay, so there's a lot of restrictions when the company owns its own common stock. The acquisition of treasury stock does not formally reduce legal capital, so we don't debit common stock. Instead, what we do, we debit a contra equity account called treasury stock. Now, some transactions with treasury stock may reduce retained earnings, but they'll never increase retained earnings. If the treasury shares are not retired, so the corporation buys its own stock back and it plans on selling it, the corporation may reissue the treasury stock at a price above what they originally bought it back at or below it. A corporation may account for treasury stock transactions by the cost method, and that's what you saw in Accounting 112, or the par or stated value method, which I don't believe is used as much as it once was. The cost method is used by the vast majority of companies that hold treasury stock, so we're going to focus on that. Under the cost method, when the corporation reacquires its capital stock, so when it buys its own common stock back, it assumes it's going to sell it rather than retire it. So here's an example. Ball Company is authorized to issue 20,000 shares of $10 par common stock and enters into several treasury stock transactions as follows. The first transaction is when they originally sell 6,000 shares. So we show this to you so you don't think they're just pulling stock certificates out of the safe. No, they're physically buying shares of stock they've already sold into the market. So here they are selling them. They debited cash when they sold them for $12 a share. They sold 6,000. They debit cash for 72,000. They'll credit common stock for 60 and the excess and additional paid in capital common stock. We've seen this already. Here's what happens though when the company reacquires out of the market 1,000 shares, paying $13 a share. They debit the contra stockholders equity account treasury stock. So this account balance will decrease stockholders equity on our balance sheet and credit cash for the full amount they paid. Now, what happens when they reissue 600 shares of this common stock that's being held as treasury stock? So now what's happening? The company is taking 600 of those 1,000 shares that they just bought out of the market and selling them back into the market. For how much? $15 a share. They debit cash for the amount of cash they're getting. 600 times $15. They credit treasury stock for the number of shares being sold times what they just bought them back at, that $13 a share. So they reduce the treasury stock account by crediting it $7,800. They sold this for a profit, but we don't credit a gain account. We credit additional paid-in capital from Treasury stock. And that's very important. We keep an account called additional paid-in capital from Treasury stock, and we'll see why in a few seconds. So they were lucky. They were able to sell some of the shares of stock and make some money. Let's look at 4. In 4, they're selling 200 shares of those common stock held in Treasury, but they're only selling them for $8 a share. So they're getting cash of $1,600, 200 shares times $8. They have to credit the Treasury stock account for the 200 shares times $13 or $2,600. They debit additional paid-in capital from Treasury stock if they have an account called additional paid-in capital from Treasury stock and it has a balance in it. In this case, our additional paid-in capital from Treasury stock has a credit balance in it of $1,200. So we are able to debit it for $1,000. And that means its new balance will be $200 on the credit side. Take a look at 5. They sell the remaining, it looks like, they just sell another 100 shares of Treasury stock at $10 a share. So they're going to debit cash for the $1,000 they received. They have to credit that Treasury stock account for the 100 shares they just sold at the original amount they rebought them back, $13. So they sold them for $300 less. What do they debit? They are allowed to debit the additional paid-in capital from Treasury stock to the point it reaches 0. Currently has a credit balance in it of $200, so they're only allowed to debit it for $200. The excess is debited to our garbage account, retained earnings. So if this company never had an additional paid-in capital from Treasury stock account with a balance in it, in number 4, we would have debited retained earnings for the $1,000. And in number 5, we would have debited retained earnings for all $300. So that's a little snafu you got to watch with using this method and buying and selling Treasury stock. Okay, so after all of that, what does our balance sheet look like when it comes to Treasury stock? Well, we've talked about the shareholders' equity a little bit already. Remember, contributed capital, we are listing all the accounts with regards to original investments of stock, how much money we received when we sold the stock for the first time. That's generally what's in there. So we'll have in there for this company, common stock, $10 par. There's 20,000 shares that were originally authorized to be sold, 6,000 shares are sold, of which 100 are being held as Treasury. We could also state this as 5,900 are outstanding. Outstanding shares of stock are the number of shares issued minus the number of shares being held as Treasury stock. That would be 60,000 the balance. Additional paid-in capital common stock is 12 grand. So notice we are not reducing the dollar amounts in common stock or additional paid-in capital for this Treasury stock. Nope, because it's still common stock. It's still out there. Retained earnings, I guess they tell us is $39,900. Accumulated other comprehensive income, if there's any, would be added as well. So the total amount before subtracting any balance in our Treasury stock, which it's determined we have 100 shares left from that example. We bought 1,000, we sold 600, 200, and 100. And their total balance in that account would be $1,300. And that makes sense. 100 shares at cost of $13 each. But we subtract it because it's a contra stockholders' equity. And that would be subtracted to get our total shareholders' equity. This is the whole enchilada. All the different items that could appear in our contributed capital. And this is a great example for you to use when you're working on homework and such. So we have here preferred stock is usually listed first at its par value. We're going to list any kind of characteristic it has. It's dividend. If it's cumulative, here it's convertible. We list how many shares are authorized, issued, and outstanding. Same with common stock. And we would put the balance of the account. We put par value, number authorized, number issued, and number outstanding. This company we're looking at here does not have any treasury stock. So the number of common shares issued and outstanding are the same. If there's any common stock subscriptions, we would list that with the dollar amount. Paid in capital from share options. We talked about that. Additional paid in capital on preferred stock and common stock. So the amount we received above par value when we first sold those. Any additional paid in capital from conversion of preferred stock into common stock. So now you can see all these accounts, additional paid in capital accounts, do appear in our contributed capital area. And there's an example of a contributed capital area and note from Starbucks. So you could take a read through that. Okay, and there's some questions relating to it. So lots of stuff in this chapter. I had to break it down. Even I guess we're getting into almost a 2-hour lecture on it. So if you have any questions, please post them on the discussion board. And that's it. We'll wrap up chapter 15, I think this is. Okay.